Right now, there are 80 million Americans who have no idea they're about to lose something they thought was a right. Not healthcare, not voting, not freedom of speech, something quieter. Something that lives in your wallet and keeps the lights on when your bank account hits zero. Access to credit. In 2026, a new policy designed to protect you might actually lock you out of the financial system entirely. By the end of this year, up to 80% of credit card accounts could be closed or slashed to nothing. The people who lose access first, the ones who need it most. And here's the kicker. This isn't a conspiracy. It's already happening. The banks have told us exactly what they're going to do. Stay with me, because what I'm about to show you isn't just about credit cards. It's about what happens when good intentions collide with the cold math of money and who gets crushed in between. Part 1. The promise of affordability. Let me take you back to January 10th, 2026. Just a few days ago, President Donald Trump stood in front of cameras and made a promise that millions of Americans have been waiting to hear for years. He said credit card companies were ripping people off, charging 20, 30, sometimes even 35% interest on balances, and he was going to stop it. How? By capping credit card interest rates at 10%, flat, across the board. No more gouging, no more exploitation, just affordable credit for everyone. And on paper, it sounds incredible, right? If you're carrying $5,000 on a credit card at 28% interest, you're paying about $1,400 a year just in interest. Under a 10% cap, that drops to $500. You just saved $900. Multiply that across millions of cardholders, and analysts estimate this could save American consumers roughly $100 billion a year. $100 billion. That's real money. That's groceries. That's rent. That's breathing room. So why would anyone oppose this? Here's where the story gets darker. Because Trump didn't just announce the cap. He said it would take effect on January 20th, 2026. That's 10 days from now. 10 days. And he didn't clarify how this would actually work. Would it be an executive order? Would it require Congress to pass a law? There's already a bipartisan bill out there, the 10% Credit Card Interest Rate Cap Act, introduced by Bernie Sanders and Josh Hawley, strange bedfellows, a Democratic Socialist and a populist Republican. But Trump hasn't said if he's using that or going around it. The uncertainty alone is enough to make bankers sweat. And that's the thing. This policy isn't just popular, it's emotionally bulletproof. Who's going to stand up and defend credit card companies? Nobody likes them. They're right up there with cable companies and the IRS. When you tell people that banks are charging 30% interest on a piece of plastic, people get angry. They should get angry. Because for a lot of Americans, credit cards aren't a luxury. They're survival. They're the thing that pays for the emergency room visit when you don't have insurance. The thing that covers the car repair so you can still get to work. The thing that bridges the gap between paychecks when the rent is due and your account is empty. Credit cards have become essential liquidity for middle and lower income households. That's not an exaggeration. Studies show that nearly 40% of Americans couldn't cover a $500 emergency without borrowing. So when Trump says he's going to make borrowing cheaper, people listen, they believe, they hope. But here's the tension. The thing nobody wants to talk about in the middle of all this emotional momentum. Credit cards don't work like car loans or mortgages. They're not backed by collateral. There's no house to repossess, no car to tow. When you swipe a credit card, the bank is lending you money based on nothing but a promise that you'll pay it back. And some people keep that promise, others don't. That's the risk. And the interest rate? That's the price of the risk. So when you cap the price at 10%, you're not just cutting into bank profits, you're eliminating their ability to charge for risk. And when banks can't charge for risk, they stop taking risks. They stop lending to risky people. And who are risky people? Not the folks with perfect credit scores and steady six-figure incomes. It's the people who need credit cards the most. The ones living paycheck to paycheck. The ones with medical debt. The ones rebuilding after bankruptcy. The ones Trump says he's trying to protect. This is the central conflict of the entire story. Price controls versus risk-based lending, moral outrage versus balance sheet math, the promise of affordability versus the reality of access. And what we're about to see over the next few months is what happens when those two forces collide, because one of them has to give. And spoiler alert, it's not going to be the banks. Part 2. Inside the machine. how credit actually works. Let me explain how credit cards actually work. Not the fairy tale version, the real version. When you apply for a credit card, the bank runs your FICO score. That's a number between 300 and 850 that represents how risky you are as a borrower. If your score is 750 or higher, you're golden. Low risk. Banks love you. They'll give you a card with a $15,000 limit and charge you maybe 12 to 16% interest. Not great, but manageable. If your score is in the 600s, things get trickier. You might still get approved, but your limit will be lower, 3,000, maybe 5, and your interest rate, 20 to 25%. Now, if your score is below 600, you're subprime, high risk. The bank knows there's a decent chance you won't pay them back, so if they approve you at all, it'll be for a small limit, maybe $500 to $1,000, and the interest rate, 30% or higher. Why? Because statistically, a significant percentage of subprime borrowers default, meaning they stop paying altogether. The bank has to eat that loss, so they charge the ones who do pay enough interest to cover the ones who don't. It's not pretty, but it's math. This is called risk-based pricing, and it's the foundation of the entire credit card industry. High-risk borrowers pay high rates, low-risk borrowers pay low rates. Everyone gets access, but the price adjusts based on probability. It's not fair in a moral sense, but it's functional. It keeps credit flowing to people who need it, even if the cost is brutal. Now, here's where Jeremy Barnum comes in. He's the chief financial officer of JP Morgan Chase, the biggest bank in America. On January 13th, 2026, during JP Morgan's fourth quarter earnings call, Barnum was asked about Trump's interest rate cap, and he didn't mince words. He said the credit card ecosystem is already competitively optimal. Translation: banks aren't gouging you. They're charging exactly what they need to charge to make the math work. He argued that credit card margins aren't excess profit. They're risk compensation, money set aside to cover the borrowers who never pay. Now, you can debate whether that's true. You can argue that banks are absolutely making massive profits off credit cards. And they are. JP Morgan alone made over $6 billion from credit card interest in 2025. But Barnum's point is that those profits aren't pure greed. They're a buffer, a cushion against defaults. And when you cap interest rates at 10%, you eliminate that cushion, especially for subprime borrowers. Here's the thing. If a bank lends to a subprime borrower at 30% interest, and 20% of those borrowers default, the bank still comes out okay. The ones who pay cover the ones who don't. But if you cap the rate at 10%, the math breaks. The bank can't charge enough to offset the defaults. Every subprime borrower becomes a losing bet. So, what does the bank do? They stop lending to subprime borrowers. Simple as that. This isn't new. This is basic economics. Price controls have been tried over and over throughout history. Rent control, gas price caps, wage freezes, and the result is almost always the same. When you artificially lower the price of something below its market rate, you don't get more of it, you get less. Supply contracts. In this case, the supply is credit, and the contraction is already beginning. Barnum warned that if the cap goes into effect, access to credit would be severely reduced on a broad basis, not just for subprime borrowers, for everyone, because banks don't want to take risks they can't price. And when prices can't adjust, availability does. That's the quiet part, the part Trump didn't mention in his speech. You might save money on interest, but only if you still have a credit card. Part 3. The breaking point. So let's talk about what happens next. Because this isn't theoretical, the banks have already told us. JP Morgan and the broader banking sector have made a very clear prediction. If the 10% cap takes effect, access to credit will be severely reduced. Not slowly, not gradually, severely. And the first people to lose access will be low-income and subprime borrowers, the exact people Trump says he's trying to help. Here's how it works. Banks will look at every single credit card account they have and run the numbers. Can we make money on this account at 10% interest? If the answer is yes, the account stays open. If the answer is no, the account gets closed, or the credit limit gets slashed. And for millions of Americans, the answer will be no. Analysts at Wolfe Research and the Electronic Payments Coalition have run the projections. They estimate that up to 80% of existing credit card accounts could be at risk of closure or significant limit reductions. 80%. That's not a typo. That's not fear-mongering. That's what happens when you eliminate the pricing mechanism that makes unsecured lending possible. Now, not all of those accounts will be closed outright. Some will just have their limits cut. If you have a $5,000 limit now, it might drop to $1,000 or $500 or $0. The bank doesn't have to tell you why. They just do it. And suddenly, the credit card you've been relying on for emergencies doesn't work anymore. This is what the industry is starting to call a credit desert, a landscape where credit exists, but only for the people who don't really need it. If you're wealthy, if you have a perfect credit score, if you have assets and income, you'll be fine. You'll still get approved. You'll still have access. But if you're living paycheck to paycheck, if you've had financial trouble in the past, if you're just starting to build credit, you're out. The door closes, and it doesn't open again. And here's the really insidious part. The banks don't have to wait for the cap to actually become law. The uncertainty alone is enough. As soon as Trump made the announcement, banks started tightening underwriting standards. They started reviewing accounts. They started preparing for the worst. Because even if the cap gets blocked in court, even if Congress kills the bill, the damage is already done. Credit disappears in anticipation, not just enforcement. This is the breaking point, the moment when the promise of affordability collides with the reality of risk. And the people who get crushed in the middle are the ones who can't afford to lose access. The single mom who uses her credit card to buy groceries at the end of the month. The college student who needs it for textbooks. The guy whose car breaks down and doesn't have $1,500 sitting in savings. They're the ones who lose. Part 4. The trade nobody sees. Okay, so let's say the cap goes through. Let's say Trump wins. Interest rates get capped at 10%. Consumers save $100 billion a year. That's the headline. That's the victory lap. But what's the fine print? What do we give up to save that $100 billion? Here's what the banks have already told us they're going to do. If they can't make money on interest, they'll make it somewhere else. And that somewhere else is fees. Lots and lots of fees. First, rewards programs are dead, gone, evaporated. If you've got a credit card that gives you 2% cash back, or airline miles, or hotel points, say goodbye. Those rewards are funded by interest revenue. When interest revenue disappears, so do the rewards. Banks have already said they'll eliminate or drastically reduce rewards, points, and travel miles across the board. So that card you use to rack up free flights? It's about to become a useless piece of plastic. Second, annual fees are coming back, and not the $50 kind. We're talking $100, $200, maybe even $500 a year just to keep the card active. Banks used to charge annual fees back in the 80s and 90s, but competition killed them off. Now, they're coming back with a vengeance. If you want access to credit, you're going to pay for the privilege. Upfront, every year. Third, maintenance fees. Monthly fees just for having the card, even if you don't use it. $10 a month, $20 a month, it adds up fast. And if you miss a payment or go over your limit, the penalty fees are going to skyrocket. Late fees could go from $25 to $75. Over-limit fees could hit $100. The banks are going to extract every dollar they can from the people who slip up. Fourth, stricter underwriting standards. This is the big one. Banks are going to stop approving new accounts for anyone who doesn't have pristine credit. If your FICO score is below 700, forget it. You're not getting a card. And if you already have one, they might close it just to reduce their risk exposure. The days of easy credit are over. So here's the trade. You save money on interest, but you lose access to rewards. You lose the ability to borrow without fees. You lose the flexibility that made credit cards useful in the first place. Cheap credit becomes exclusive credit. And the people who can't afford the fees, who don't have perfect credit, who need borrowing the most, get shut out entirely. This is what I mean when I say savings on paper, scarcity in practice. Sure, if you still have a credit card, you might pay less interest, but most people won't still have a credit card. They'll be locked out. And when they need money, they'll have to go somewhere else. Somewhere worse. Part 5. The legal minefield. Now, let's talk about whether this can even happen, because there's a massive legal problem with Trump's plan. And it's this. There is no federal law that caps interest rates for the general public. Let me say that again. There is no existing federal law that puts a limit on what credit card companies can charge. There's a law for active duty military members. The Military Lending Act caps their rates at 36%, but for everyone else, nothing. Zero. The market decides. So when Trump says banks would be in violation of the law if they don't comply with the 10% cap, he's wrong. Legally contested. Because the law he's referring to doesn't exist yet, it would have to be passed by Congress. And that's where the Sanders-Hawley bill comes in. Senate Bill 381, the 10% Credit Card Interest Rate Cap Act, introduced by Bernie Sanders and Josh Hawley. It's sitting in committee right now. It hasn't been voted on. It hasn't been signed. It's just a proposal. And even if it passes, it would face immediate legal challenges. The banking industry has already signaled they're ready to sue. JP Morgan said everything is on the table to block the cap. That includes litigation. They'll take this to court. They'll argue it violates the Constitution. They'll drag it out for years. And in the meantime, the market freaks out. On the day Trump made the announcement, financial stocks tumbled. Investors started pricing in the loss of one of the banking sector's most lucrative revenue streams, credit card interest. $6 billion a year for JP Morgan alone. Multiply that across the entire industry, and you're talking tens of billions in lost revenue. The market doesn't like that. The market panics. But here's the kicker. The regulatory ambiguity itself is enough to tighten credit. Banks don't need to wait for the law to pass. They don't need to wait for the court battles. They just need to see the writing on the wall. And the writing is clear. If there's even a chance this cap becomes real, they're going to start pulling back now, closing accounts, reducing limits, tightening standards. Because the risk of getting caught with a portfolio full of unprofitable accounts is too high. So, credit disappears in anticipation, not just enforcement. The threat alone is enough to reshape the market. And the people who lose are the ones who can't prove they're worth the risk. Part 6. The human cost of a credit desert. Let's zoom in. Let's talk about real people, not statistics, not projections. People. Meet Sarah. She's 28. She works 2 jobs, one at a grocery store, one at a coffee shop. Together, she makes about $32,000 a year. She has a credit card with a $1,500 limit. She uses it for emergencies. Last year, her car broke down. The repair cost $800. She put it on the card, paid it off over 6 months. The interest hurt, but she managed. That credit card kept her employed. Without it, she couldn't get to work. Now imagine Sarah's card gets closed, or her limit drops to $300. The next time her car breaks down, she's stuck. She can't borrow from a bank. Her credit score is 620. Not terrible, but not good enough under the new standards. So where does she go? Payday loans, pawn shops, title lenders, the unregulated fringe of the financial system. And here's the cruel irony. Those places charge way more than credit cards. Payday loans can have effective interest rates of 400% or higher. Title loans aren't much better. So Sarah, who was supposed to be protected by the 10% cap, ends up paying even more because the cap didn't give her cheaper credit. It took away her access to credit and forced her into the arms of predators. This is the paradox. Protection policies increasing financial precarity. It's not a hypothetical. It's already happened before. When states have tried to cap payday loan rates, the lenders just leave, and the borrowers don't stop needing money. They just find worse options. Loan sharks, illegal lenders, employers who exploit them. And it's not just Sarah. It's millions of people like her, subprime borrowers, low-income households, people rebuilding after bankruptcy, people with medical debt, people who made financial mistakes and are trying to recover. They're the ones who lose access first, and they're the ones who need it most. Credit cards might charge 30% interest, but at least they're regulated. At least there's a paper trail. At least you can dispute charges and file complaints. Payday lenders don't offer that. Pawn shops don't offer that. When you lose access to the formal credit system, you fall into the shadows, and it's really hard to climb back out. The industry has warned about this. They've said that borrowers will be forced toward less regulated, more costly options, and people dismiss it as fear-mongering. But it's not. It's what happens every single time credit access contracts. The demand doesn't disappear. It just moves underground. And here's the long-term damage. Once you're locked out of the credit system, it's almost impossible to get back in. If your card gets closed, your credit score drops. If your score drops, you can't get approved for new credit. If you can't get approved, you can't rebuild your score. It's a trap, and for millions of people, this policy could be the thing that traps them forever. This is the human cost of a credit desert. It's not abstract. It's Sarah. It's your neighbor. It's the guy who delivers your pizza. It's the single parent who's one emergency away from disaster. And when the policy is framed as protecting them, but it actually destroys their last safety net, that's not protection. That's abandonment. Part 7. The silent redefinition of a right. So let's step back. Let's look at the whole picture. Because this story isn't really about credit cards. It's about something bigger. It's about the quiet redefinition of what we think we're entitled to, what we think is a right. For the last 50 years, borrowing has felt like a right. You turn 18, you apply for a credit card, you get approved. Maybe your limit is low, maybe your rate is high, but you get access. The system is open. Imperfect, expensive, often predatory, but open. And that openness has created a kind of social contract, the idea that if you need money, you can borrow it. Not from a loan shark, not from your boss, from a bank, a regulated institution, with rules, with protections. But what this policy does, intentionally or not, is reframe borrowing as a conditional privilege. Something you have to earn, something you have to qualify for. And the bar for qualification just got a lot higher. If you don't have a 750 FICO score, if you don't have stable income, if you don't have assets, you're out. Borrowing isn't a right anymore. It's a reward for financial success. And if you're not successful, you don't get to participate. Now, let me be clear. This policy is a political win. It's popular. It's emotionally satisfying. It punishes banks who are easy to hate. It promises immediate relief to people who are drowning in debt. And if you're one of the people who keeps their credit card after the cap, you will save money, no question. But here's the distribution. Here's who wins and who loses. Winners: high FICO borrowers, people with credit scores above 750. They'll keep their cards. They'll pay lower interest. They'll save thousands of dollars a year. Cash, rich households. People who don't really need credit cards because they have savings. They'll benefit from lower rates on the cards they barely use. Losers, marginal borrowers, people with scores in the 600s or below. They'll lose access entirely. Small emergencies, the things credit cards are supposed to cover. Car repairs, medical bills, rent gaps. Those emergencies don't stop happening, but the tool to handle them disappears. Financial mobility, the ability to borrow your way out of a bad situation, to invest in education, to start a business, to take a risk. That mobility evaporates for millions. And that brings us to the unresolved question. The question nobody in politics wants to answer. Is access to credit a market outcome or a social good? If it's a market outcome, then fine. Let the banks decide who gets credit and at what price. Risk-based pricing, supply and demand, no intervention. But if it's a social good, if we believe people have a right to borrow money when they need it, then we have to build a system that guarantees access, not through price controls, but through public options. Government-backed credit, postal banking, something that doesn't rely on profit motive. The problem with the 10% cap is it tries to split the difference. It treats credit as a social good by capping the price, but it leaves distribution in the hands of private banks who operate on profit. And that doesn't work. You can't force banks to lend at a loss. They'll just stop lending. And when they stop lending, the people who need credit the most are the first to lose it. So here's the forensic takeaway, the thing I want you to walk away understanding. Price controls don't erase risk, they relocate it. When you cap interest rates, you don't eliminate the risk of default. You just shift it from being priced into the interest rate to being priced into access. The risk doesn't disappear, it just becomes a filter. And the people who can't pass the filter get locked out. In 2026, borrowing doesn't get cheaper, it gets scarcer. The right to borrow doesn't disappear overnight. It narrows. It becomes exclusive. It becomes something you have to earn, not something you can expect. And for tens of millions of Americans, that shift will be the difference between staying afloat and going under. Trump promised to stop the banks from ripping people off. And maybe he will. Maybe interest rates will drop. Maybe some people will save money, but for every person who saves $100 on interest, there will be someone else who loses their $1,500 credit limit, who can't fix their car, who can't pay for their kids' medicine, who falls through the cracks. And that's the trade. That's the hidden cost. That's what happens when moral outrage meets balance sheet math. Somebody always pays. The only question is who. This is the silent redefinition of a right. The slow transformation of borrowing from a universal tool into a privilege for the financially secure. And it's happening right now, not in some dystopian future. Right now, in 2026, in the name of affordability, in the name of protection, in the name of fairness. But fairness, it turns out, is a question of access. And when access disappears, fairness doesn't matter anymore. You can't benefit from a 10% interest rate if you don't have a credit card. You can't save money on borrowing if you're not allowed to borrow. The promise was affordability. The reality is exclusion. And that's the story. That's what's really happening behind the headlines, behind the political theater, behind the promises. The right to borrow isn't being taken away by force. It's being quietly withdrawn, account by account, limit by limit, approval by approval, until one day, millions of people wake up and realize the safety net they thought would always be there is gone, and by then, it'll be too late to do anything about it.